Hello, welcome to our webinar, and thank you for taking the time out of your busy day to join us. We're happy to partner again with the Options Clearing Corporation to bring you this webinar today on core concepts of options. My name is Gina Bocayas, and I'm on the management team of Regal Securities, which is the parent company of eOption and its sister company, InvestTrade. A few housekeeping matters before we start. The session today will last about an hour. Our speaker will present for 55 minutes, and then he'll address your concerns at the end. We ask that you look now to locate the Q&A box on your screen. If you have any questions at all during the presentation for our speaker, please feel free to type them into the Q&A box throughout the presentation, and our speaker will answer those at the end. We ask that you use the Q&A box and not the chat box, as our speaker will only see what's in the Q&A. And to tell you briefly about eOption, as our name implies, we're a brokerage firm that specializes in option and stock trading at ultra low commission rates. We offer you some of the lowest rates around, including zero commission on stocks, and options are just 10 cents per contract. And at eOption, we also offer you many options for your trading. You can also trade exchange-traded funds, bonds, mutual funds, and foreign stocks, in addition to stocks and options. And our founder was one of the founding members of the Chicago Board Options Exchange and has been an active stock and options trader for nearly 50 years. He created his ideal trading company that caters to those who have a passion for investing. And at eOption, we support trading education, and we usually do about 1 to 2 webinars per month with industry experts. So we hope you'll continue to join us. We also encourage you to subscribe to our YouTube channel to see our library of trading videos, no matter what level of investing you're at. We also have all kinds of playlists on there for beginning traders, as well as more experienced option strategies. And you can go to youtube.com/eoption to take a moment to subscribe. And I also put a direct link up in the chat box. So if you look in the chat box, there's a link. Feel free to click on that. And now I'd like to just quickly go over our disclaimer. We encourage every investor to make their own investment decisions. And at eOption, we don't give advice or investment recommendations. So if you could just take a moment to glance at this. And if you look at the 4th bullet point, options do carry a high level of risk and are not suitable for all investors. Certain requirements must be met to trade options through Regal or any of its divisions. And there's also a booklet on there called Characteristics and Risks of Standardized Options. There's a link. You could also contact our trade desk, and we'd be happy to give you that pamphlet that talks all about the risk of option trading. So I'd like to turn our attention to our speaker now, Ken Keating, who is a principal of investor education at the Options Clearing Corporation. Ken has been a trader for over 25 years and has worked on the trading floor of the Pacific Coast Stock Exchange and the Chicago Board Options Exchange. And he's held positions as a floor market maker, floor specialist, risk manager, and off-floor prop trader. He's also worked as an options portfolio manager as well as trading for himself. And without further ado, I'll turn it over to Ken. Thank you.
Well, thank you, Gina, and welcome everyone to the first of many webinar presentations for 2023. My name is Ken Keating, and once again, as Gina mentioned, I'm a principal at OCC Investor Education, as well as an options industry council instructor, and I'll be giving today's presentation on core concepts of options. So I just want to send a big thank you out to Gina and all the great people at eOption for all they do for the ever-growing community of options investors with their competitively low rates and their amazing trading platform. And I want to thank them for hosting this presentation today. So my name is Ken Keating, and I'm going to be talking about option core concepts. So if you're new to options, this is going to be a really, really good webinar for you. So I just wanted to let you know options can be kind of complex. Some people are very intimidated by options, but I just want to let you know that with a little bit of repetition and kind of going over this subject over and over again, this stuff will become second nature. It's actually really not that complicated, but just bear with me, and hopefully you'll have a better understanding once the presentation is over. So we always have to do some housekeeping as well. So this is our disclaimer. So options, once again, are rather complex vehicles and need to be properly understood before trading in a live account. So anyone who's looking to trade options should thoroughly read and understand the characteristics and risks of standardized options, which you can obtain by visiting us at optionseducation.org to download a digital copy. Or as Gina mentioned, you can always reach out to your broker or any exchange on which options are traded if you prefer a physical copy. In order to simplify the calculations used today, commissions, fees, margin interest, and taxes have not been included. And lastly, any strategies that we discuss here today are strictly for illustrative and educational purposes. All right, here are some of the trademarks and logos that you will see throughout the presentation. This is strictly for all the lawyers at OCC. All right, a little bit about OIC. Who exactly is the Options Industry Council? Well, OIC, we are effectively the educational arm of our parent company, OCC. So OCC is the Options Clearing Corporation and is the world's largest equity derivatives clearing house for exchange-listed options, as well as the foundation for secure markets in the United States. So OIC started out as a collective in 1992 to better educate the public both on the risks and the benefits of exchange-listed options. And we do that primarily through our website, optionseducation.org. There you'll find online courses, podcasts, videos, as well as additional webinars. And this is a completely free service. And the reason why we can offer you the service free of charge is because we are fully funded by our parent company, OCC. So we really have no hidden agenda. We're not looking to upsell you on subscriptions or tiers of service or additional products. We just want you to be better educated on the product, and hopefully you're making good decisions and hopefully making a lot of money along the way. Now, just know that as this is a free service, we are not registered advisors. So we cannot talk to you about specific stocks, setups, where you should be investing your money in the options market, et cetera, et cetera. We can't give you advice, but we can talk to you about options strategy, options theory, or how a corporate action may impact your options position. So you can always shoot us an email at options@theocc.com Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time with any and all of your options related questions. We have a very deep bench of knowledgeable people on our team, all ex-traders or brokers. We have well over 100 years of trading and brokerage experience. So if you ever have a question regarding the product, certainly shoot us an email. All right, here's a great little chart. This is the annual options volume over the last 20 plus years. And as you can see, the trajectory and growth of the product has really just skyrocketed. So I remember when I left the trading floor right around 2000, Chicago, when I was trading on the CBOE. And as you remember, that was kind of right when the internet bubble cracked. And back then we were doing about 2.8 million contracts on a daily basis, okay? You contrast that today, where just for 2023 alone, we're averaging 46 million contracts a day. It's just crazy. And as you can see, 2022 was a record year for OCC, where we cleared and settled nearly just over 10 billion contracts, 10.3 billion contracts, with an average daily volume of 41.1 million contracts. So you remember 2008 was the housing crisis, 2011, the sovereign debt crisis, 2020, COVID, 2021, the war in Ukraine, rising interest rates, and more recently, all these, all the banks that have been in the news lately with their rate exposure. That's certainly been causing a lot of turmoil and volatility in the market. So once again, there's no lack of investors using the product both to hedge and speculate amidst all the volatility that we've been witnessing over the last couple decades. All right, with that out of the way, let's get started. So here's today's presentation outline. So this is going to be a broad overview of core concepts of options. So first, we're going to be talking about the exercise and assignment process. Then we will get into options pricing. We'll then look at historical and implied volatility. This is always a very crucial part of options pricing. Anybody who's trading options should have somewhat of an understanding of how implied volatility affects them and their options. So we'll talk about that. We'll also look at the Greek theta, which is your option sensitivity to changes in time or time decay. And lastly, we'll finish up with dividends and how dividends are priced into an option and how they can impact your option position. All right, so before we get started, one of the biggest questions we get at OCC is, well, who determines which products get options listed on them? Not all securities have options on them. So this is the criteria that exchanges use before they list options on a product. So shares must be trading on a national stock exchange. Okay, they can't be trading on the pink sheets or OTC market. There must be a minimum share price of $3 per share for 3 consecutive trading days. There has to be at least 7 million publicly shares held outstanding, and that excludes directors and 10% holders. There has to be at least 2,000 shareholders in the company, and this criteria applies both to equity and ETF listings. So, just know that OCC, we really have no say in which products get options on them. It's really up to the exchanges. And just because a stock meets these criteria doesn't necessarily mean it automatically gets options listed on them. Usually the more popular issues, if a hot IPO comes up and has a lot of interest in the public, generally there'll be options listed on it. But remember that a stock can't have options listed on it for at least a minimum of 3 trading days from the IPO date. So once again, the exchanges are all about volume. That's how they make money. So they're the last thing they want to do is list a bunch of options on stocks that just don't trade. So usually the stocks that are in the news, that are popular, that have a lot of interest will typically have options listed on them. If you do have a product that doesn't trade options, you can always reach out to your broker and have them request options. Once again, there's no guarantee they'll get listed, but you can always put in a request if you're interested in a particular stock that doesn't have options already on it. Okay, so let's get started. Exercise and assignment. So when we talk about options, okay, there's 2 types of products. There's the call and then there's the put. So a call is the right to buy 100 shares of an underlying on or before expiration at a specified strike price. Puts, on the other hand, are just the opposite. A put is the right to sell 100 shares of an underlying at your strike price on or before expiration. So we always say that when you own a contract, buyers have rights and sellers have obligations. So when you buy an options contract, you're kind of in the driver's seat. You can elect to either hold that contract, you can elect to sell it out into the market price to monetize it, or you can choose to exercise it. In the case of a call, if you exercised a call, you would exercise your right to buy that stock at your strike price on or before expiration. And in the case of a put, you'd be exercising your right to sell those shares on or before expiration. Now, remember that for every buyer, there's a seller, and every seller, there's a buyer. So if somebody buys a call, somebody else has to sell a call. So the seller, in this case, doesn't have any rights, but they have obligations. So somebody who sells a call would be obligated to sell those 100 shares on or before expiration at their strike price. And in return for this obligation, they take in a certain amount of premium. Okay, that's theirs to keep regardless of what happens. But just know that, once again, buyers have rights and sellers have obligations. In the case of a put option, okay, somebody who sells a put would be obligated to buy those shares on or before expiration if they got assigned. So we'll get into the exercise and assignment process in a bit. But just once again, it's very important that buyers of options have rights and sellers of options have obligations. All right, so once again, a buyer has the right, in the case of a call, to buy 100 shares of stock on or before expiration, whereas a put, the owner has the right to sell 100 shares of stock on or before expiration at their strike price. So typically, if somebody wants to exercise their contract, okay, at expiration, if that contract is a penny or more in the money, typically it would get automatically exercised. So At OCC, we have this process called X by X processing, and this is more of an administrative convenience for our member firms. But if a contract is a penny or more in the money, and the buyer doesn't trade out of it, most likely it would be automatically exercised. Okay, and same thing for the put buyer. If that put was in the money by a penny or more, typically it would get automatically exercised. Now that's for our member firms. So just know that your broker might have a different exercise threshold at expiration. So you want to keep that in mind and talk to your broker about what their specific threshold is for automatic exercise. Another thing to keep in mind that people who exercise now in an American style option, which most options that trade in the United States on stocks and ETFs are American style, meaning that they can be exercised on or before expiration for whatever reason the long holder wishes. Now, just because you can exercise early doesn't necessarily mean you're going to want to exercise early, because there has to be an economic incentive for somebody to exercise early. Because by exercising a contract early, you're going to be foregoing some time premium or extrinsic value. We'll get into that in a few slides, but you're going to be foregoing some of that option premium by exercising early. So there has to be an economic incentive for you to exercise early. We'll also get into that as well. But just know that if you want to exercise for whatever reason before expiration, you would have to file an exercise notice with your broker in order to do so if that's something you wish to do. And once again, only option buyers may exercise because they own the rights. Option sellers don't have really any rights, they just have the obligations. So once again, as option buyers have rights, sellers have obligations. So somebody who sells an option, whether it's a call or a put, now has the obligation to either sell 100 shares of a particular stock or ETF in the case of a call, or buy 100 shares of a stock or ETF in the case of a put at their strike price should they get assigned. Now, if you're short an option and you get assigned, you would receive an assignment notice from your broker instructing you that you were assigned, and in the case of a call, you would be paid your strike price times 100, and you'd have to sell 100 shares of stock at your strike price. In the case of a put, you would be paid your strike price times 100. You would have to pay your strike price times 100, and you would then take delivery of 100 shares of stock of that particular security. And only option sellers may be assigned on an options contract. One thing I want to kind of mention is that there's this myth in the options industry that 90% roughly of options expire worthless. And I'm here to tell you that it's simply not true. We have looked at the data over years and years and years, and consistently, roughly about 72% of options contracts are closed out on or before expiration. In other words, people who are long the contracts will sell them to close. People who are short them will buy them back to close. Only about 6% of options are ever really exercised, and the remaining 22% of options are expire without value. So just know that that not all not that 90% figure that I mentioned of contracts expiring worthless, it's simply not true. All right, so now let's get into options pricing. So when you pull up an options a screen, you pull up your on your broker's platform, and you see your options chain, you look at all these bids and offers and flashing colors and lights and whatnot. And you ask yourself, well, who makes these option prices? Well, the prices that you see at any given time are the collective markets, the bids and offers of anybody participating in that market at that time. It could be individual investors such as yourselves. It could be institutional investors such as banks, pension funds, hedge funds. It could be professional market makers like I used to be, somebody who's making a two-sided market and trying to capture a bid-ask spread. So what the market that you see is called the NBBO, or National Best Bid, Best Offer. And it's the consensus of all the best bids and offers. So let's just say we're looking at stock, it's a $50 stock, and we're looking at the 55 level calls that expire in a month. And maybe the market on those calls is $1 bid offered at 120, 100 up, meaning that there's 100 contracts bid for $1 and there's 100 contracts offered at $1.20. Well, the midpoint of that market would be 110, right? Right in the middle of $1 and 120. And traders would call that 110 price fair value. And so this is kind of what I used to do as a market maker. I would say, okay, well, I'm going to model this option. I'm going to say it's worth 110. So if I pay $1 for it, I'm making 10 cents in theory. And if I sell it for 120, in theory, I'm also making 10 cents. That's called a theoretical edge. And this is how market makers make their money. They trade on their bid and on their offer all throughout the day, and they build this mountain of theoretical edge. Granted, it doesn't always work out that way. Market makers do lose money too, but in theory, that's how somebody who's a professional trader makes money, trading a bid-ask spread. But ultimately, what's that option really worth? Well, it's really worth what the market is willing to pay for it. So traders and investors will use models or pricing models as a guideline, but those models don't dictate they don't tell you how to trade. They only really value the contracts that you're looking at. So ultimately, the forces of supply and demand override whatever theoretical values you might see in an options market. So let's just say, go back to the example I used before, where the stock's trading 50 and we're looking at the 55 level calls, and they are $1 bid offered at 120, and there's 100 on the offer. Well, let's just say a big order came in to buy 5,000 contracts. Well, there's only 100 contracts offered at 120. So those will trade 120. Maybe some will trade 125, some will trade 130, 135, 140, all the way up to 150. Let's just say in this example that this big order gets cleaned up at 150. So now the new market is 140 bid offered at 160. Okay. So, and what if the stock is in the same spot? What's changed? Well, the demand for options has pushed up the fair value of that option from 110 up to 150. It's gone up by 40 cents due to the demand for those options. So, once again, just like any product that you see, and you go in the supermarket these days, everyone's been experiencing inflation lately. The price of eggs and bacon and meat, everything's gone through the roof because we have inflation in our economy right now. And that's just, more demand chasing a lower amount of supply. Well, it's no different than in the option market. So once again, your models will allow you to come up with theoretical values for your options, but just know it's the forces of supply and demand that ultimately dictate what the prices that you see at any given time are for those options. And when you look at a snapshot of an options chain, okay, that snapshot, that bid-ask spread at any given time, that's a snapshot of what the market is valuing those options at that particular moment in time, and that could change based on, big demand for options, big supply for options. So, the supply and demand concept is working daily, all the time, and it's really impacting that options price, throughout its lifetime. All right, so now let's look at moneyness. What exactly is moneyness? Well, in the case of a call, let's say stock is trading for 50. And a call would be considered in the money if the strike price is below the stock price. So in this case, we have Jan, Feb, and April 40 calls and 45 level calls. These options would be considered in the money. So if we bought a Jan 40 call, okay, that's the right to buy stock for 40, even though it's trading 50. Okay, we would say that option is in the money by $10. Okay, so so basically, if the call has a strike that's below the stock price, it would be considered in the money. Now, at the money options have strikes that are roughly the same as the stock price or close to the stock price. So in this case, with the stock trading 50, the Jan, Feb, and April 50 calls would be considered the at the money options. And likewise, the out of the money options would be considered strikes that are above the stock price. In this case, the 55 and 60 level strikes would be considered out of the money. Because if we bought a Jan 60 call, remember that option is the right to buy 100 shares of stock at 60, even though it's trading for 50. Well, nobody's going to want to do that. But obviously this option is probably not going to be trading for a very high price, or it's in terms of moneyness, it's going to be trading at a lower price than the at the money and in the money contracts. But if all of a sudden stock starts rallying from 50 up to 60, these little out of the money options will take on a tremendous amount of value. Okay, so once again, 3 different types of options: in the money, at the money, and out of the money contracts, and that's when it comes as applied to calls. Now, puts, on the other hand, work just the opposite way. So a put would be considered in the money if its strike price is above the stock price. So in this case, with the stock trading 50, the 55 and 60 level puts would be considered in the money. If we bought a Jan 60 puts, the right to sell shares at 60, even though it's trading for 50. So with that option would be considered $10 in the money. Same way with at the money options for puts. A put would be considered at the money if the strike is the same price as the stock price. So stock trading 50, the 50 level puts for Jan, Feb, and April would be considered at the money. Now, it doesn't have to be exactly at the money. If it's really the strike price that's closest to where the stock is trading. So with the stock trading 49, if there were no 49 level strikes, the 50 call and put would still be considered roughly the at the money options. And lastly, a put would be considered out of the money if its strike price is below the stock price. In this case, the 45 and 40 level puts with the stock trading 50 would be trading well below, or the strike price is well below the current stock price. All right, so now let's look at intrinsic and extrinsic value. So an options premium is comprised of intrinsic value, if any, plus some extrinsic value. So in the money options have both intrinsic value and extrinsic value. The extrinsic value is known as time value or time premium. So it's basically any premium in excess of its intrinsic value. And this is the portion of your option that decays. So as options have a finite life, and every day we get closer and closer to expiration, those options are worth less and less. So it's this time premium portion of the option, the extrinsic value, that decays as we get closer and closer to expiration. So as an example, let's just say stocks trading, let's say 50, and we're looking at the 45 level call. And that option would be $5 in the money. And we look and we see maybe the option that expires in a month is trading for $6. Well, we know that that option is $5 in the money. So $5 of that $6 is intrinsic value. The remaining dollar would be considered time value or time premium or extrinsic value. So at expiration, because that option has a finite life, an option is only worth its intrinsic value because there's no time remaining. So an option at expiration is either in the money or it's not, it's out of the money, okay? And when somebody exercises an option or chooses to exercise an option, it's only the intrinsic value of the option that is received or delivered. Any time value would be lost. Okay, visually, here's just another look at that relationship. So in the money options have both intrinsic value and extrinsic value. So your intrinsic value is if an option is in the money, it's the difference between the stock price and the strike price. That extrinsic value portion is comprised of time to expiration, volatility, we'll get into that in a bit, interest rates, and dividends. So it's this extrinsic value that decays as we get closer and closer to expiration. So in the money options have both intrinsic and extrinsic value, where at the money options and out of the money options have no intrinsic value and are comprised of nothing but extrinsic value. Okay, so it's a really important concept because it's extrinsic value is what's subject to theta or time decay. All right, so now as we were talking about pricing, now let's talk about historical and implied volatility. And this is really the most, and I always tell people this, it's really the most crucial but misunderstood aspect of trading options. So if you're trading options, you really want to have an understanding of implied volatility. I always tell people that if you can't figure out why you're making or losing money on a particular options position, invariably the reason lies with changes in implied volatility. And I'll get into that in a little bit. But this is just a really crucial aspect of options pricing. So there's two types of volatility. There's historical volatility and implied volatility. So this black line here is a stock's historical volatility. Okay, it's a backward-looking metric, and it's telling you how volatile a stock has been in the past. So this is something that's measurable. It's a statistic. It's not a prediction. And it's kind of like an EKG for your stock. It's telling you, how volatile the stock has been in the past. Now, implied volatility, only options have implied volatility. Implied volatility is a forward-looking metric, and it's telling you how volatile the market's anticipating this stock to be between now and its expiration. And this is what traders are always trying to solve for, is implied volatility. And implied volatility is constantly changing, and it's changing based on the supply and the demand for options at any given time. So let's look at comparing different historical volatility distributions. So we have three stocks here: stock A, stock B, and stock C. And each trades at a different historical volatility. Stock A is the least volatile. It trades at a 15% historical volatility. In other words, it has the least amount of fluctuation around the mean price here. Stock B is a little more volatile at 25%. Stock C is the most volatile at 35%. So just looking at these three distributions, what do you think would be, which stock do you think would have the more expensive options? Well, all things being equal, stock C probably would have the more expensive options just because it moves a lot more. But what if stock C had just reported earnings and stock A was going to report tomorrow? It could very well be that stock A has more expensive options than stock C. Okay, so what do these historical volatilities tell us about the future volatility of these stocks? Well, it really tells you nothing, right? Because historical volatility is a backward-looking metric. It's only talking about the past and showing you how volatile a stock has been in the past. So just because a stock hasn't been volatile in the past doesn't mean it couldn't move in the future. And just because a stock has been volatile in the past doesn't mean it couldn't be quiet in the future. So historical volatility really has no predictive value. Implied volatility it has more predictive value, but it's this historical volatility. It's a backward-looking metric. And for whatever reason, stock A's options could very well be more expensive than stock B or C. All right, so implied volatility's effect on options prices. So as I mentioned before, implied volatility, when traders talk about implied volatility, now you have these shows on TV that are dedicated just to options trading, all the financial news networks, and you hear these terms, implied volatility or vol. When traders are talking about implied volatility, all they're really talking about is the level of options prices. And as I was alluding to before, when options get bid up, when there's a lot of demand for options, when the volatility of the market gets crazy, options premiums will expand because people are reaching for calls, they're reaching for puts, they're bidding up the price of options. As implied volatility goes higher, option prices naturally increase. And as implied volatility goes lower, if there's a big supply of options, if there's more sellers than buyers, implied volatility will naturally decrease. And both call and put prices will increase if implied volatility goes up. And both call and put prices will decrease as implied volatility goes down. Calls and puts that share the same strike at the same expiration have a direct relationship to one another. So if implied volatility goes up for the calls, it's going to naturally go up for the puts. And if it goes down for the calls, it's going to go down for the puts as well. So let's look at an example of implied volatility in action. Let's just say we have our fictitious stock, this XYZ stock, it's trading for 100. We have 13 days to go to expiration, and our implied volatility of these options is 50%. So we see on our options chain, we could buy this call for roughly $1.85, the 105 call. It's $5 out of the money, but we're bullish on this stock. We think earnings are going to be good, and we're looking to play an upside move. So as you can see, this option has all these Greeks. These are your Greeks, and we're not going to get into extensive talk on the Greeks. Maybe at some point later in the year, I will give a webinar just on the Greeks, because the Greeks are really a subject within themselves. But one way to think about the Greeks is the Greeks are kind of like a dashboard for your options position. It's giving you feedback, just like the dashboard on your car is giving you feedback as the condition of your car that you're driving. The Greeks give you feedback as to how your options position will change given changes in the underlying stock, changes in time, changes in implied volatility, et cetera, et cetera. So let's just say we are bullish on the stock. We decide to buy these calls for $1.85. Okay. So now fast forward a week later, stock goes our way, stock's up $5 on earnings, but look at the option. You're scratching your head, you're saying, hold on, how does this stock, with the stock up $5, how come this option is worth less than what I paid for it? It's worth 65 cents less. Well, the reason why it's worth less is, one, you've got 7 days of time that have gone by, okay? Theta, which we'll get into in the next few slides, is your option sensitivity to changes in time. Remember, that option has a finite life. So the closer and closer you get to expiration, that option is worth less and less. So people who are long options or own options, Theta is working against you. So you've had 7 days of Theta working against you. But look, the implied volatility went from 50% down to 22%, because before the earnings, trade, we didn't know what the stock was going to do for earnings, but it was expected the stock was going to make a decent move. In this case, it made a 5% move. But after the earnings comes out, what was once unknown information now becomes known. There's no reason for these options to trade at a 50% volatility. The volatility is going to get crushed. So between the amount of time being 7 days have passed, plus volatility going down, this option, in fact, is worth about 65 cents less, even with the stock up $5. Now, if the stock went up to 110, now we'd be sitting on a winner, because these options, with the stock trading 110, these 105 calls would have $5 of intrinsic value. Maybe they'd be trading for, I don't know, $5.50, something like that. So we'd be sitting on a profit. But, in this case, we needed a move of roughly, just over roughly 7% to be profitable on this position. A 5% move didn't cut it. So even with a $5 increase in the share price, these calls lost value due to time decay and a decrease of implied volatility. So now let me talk about implied volatility analytics. Now, there's two types of analytics, and many brokers offer these on their platform. And the first one's called IV rank and IV percentile. So these analytics allow you to analyze the implied volatility and give you an idea of how either expensive or cheap those options are at any given time. And this is why understanding implied volatility is crucial, because the last thing you want to do is just go out and willy-nilly buy a bunch of options that are way too expensive. You get your direction right, as we saw in the previous example, but you still lose on your options. Or you don't want to sell a bunch of options too cheaply and then have them blow up in your face, right? So analyzing the level of implied volatility will go a long way to giving you an idea of how expensive or cheap these options are. Once you determine how expensive or cheap the options are, now you can decide based on your forecast, bullish, bearish, or neutral, what strategy you want to deploy, because not all option strategies, and there's plenty of option strategies out there, they don't all work in all circumstances. There's some strategies that work better in low vol environments. There's some strategies that work better in high vol environments. So once again, you want to kind of determine where vol is and then apply the appropriate strategy based on your forecast. But let's just say the IV rank, what it does is it compares the current level of implied volatility to its range over a defined period of time, typically about a year. So let's just say that we know that over the last year, this particular stock has traded between 20% and 60% implied volatility. And we know that right now the options are trading about at 40%. Well, that would yield an IV rank of 50%, right? Because 40 is right in the middle of 20 and 60. It's trading at the 50th percentile. So it's kind of in the middle. It's not cheap. It's not expensive. It's kind of like right in the middle point. If all of a sudden the IV rank were 0, that would imply that the current level is the lowest of the year, probably trading at 20% or lower. While if it were 100, it would mean the current level is the highest of the year. So it really takes 3 price points or 3 metrics. It takes the low point of the year, the high point of the year, and it compares where the current level is based on the high and low range. Now, IV percentile is a little different. IV percentile is the number of days that the implied volatility has been lower than the current implied volatility. So in other words, it doesn't just take 3 observations. It takes all the observations over a year, and it tells you how many percentage of days that the IV has been lower than the current level. So if an IV percentile was 60%, that would imply that previous levels of implied volatility have been below the current level 60% of the time, or it's just another way of saying that implied volatility is on the higher end. So once again, you can use these 2 metrics interchangeably, but it really allows you to figure out, how expensive those options are, because, once again, depending on what the market's doing, those options could be cheap or they could be expensive. And you really want to have an idea of the price level that you're either buying or selling. Some of the 3 of the most the 3 of the words that really resonate with me. We had a partner at one of our trading firms that I work for, and he had this saying that price is everything. And it really resonated with me as a trader because that pretty much sums it up. Okay, price in the options market will make you, or price will break you. Okay, if you overpay for options, over a long period of time, that's probably not going to be very profitable. And if you sell options that are too cheap, that's also probably long-term not going to be very profitable. So you really want to have an idea of the level of the options pricing at any given time. And using these analytics will go a long way to helping you understand the level of options pricing that you're looking at any given time. All right, so as I mentioned before, this is not going to be a long discussion on the Greeks. That's really for a separate webinar. But one of the Greeks, Theta, is a Greek I am going to talk about. Theta is your option sensitivity to changes in time. So in other words, how much your option is expected to lose on a daily basis if the stock just doesn't move. Because remember, if you're an options buyer, you want that stock to move either up or down to take on value. And if the stock just sits there and implied volatility doesn't change, that option, as we get closer and closer to expiration, is going to lose a little bit of value. So if our theta is 8 cents a day, we should expect that option to lose about 8 cents. So if our option is trading for $1 today, and we have, 5 days to go to expiration, and the stock opens up at the same spot tomorrow, we would expect our options to be trading for roughly 92 cents. Okay, would lose about roughly 8 cents in time value. And this represents a cash amount per option, all other factors remaining constant. And calls and puts both have negative theta amounts. So, as I mentioned before, theta is a foe to option buyers, and it's a friend to option sellers. Okay, so it's that, there's time that's always working against you if you're an options buyer, because you need movement in your security to happen before your option expires. So calls and puts both have negative theta amounts. So time decay in itself, theta, is also not linear. So we're looking at the at-the-money options. And the reason why we look at the at-the-money options is because the at-the-money options are comprised of nothing but time premium. There is no intrinsic value. It's just time premium. So as you can see, this line, okay, gets steeper and steeper as we get closer to expiration. Here's expiration down here, but as we get closer and closer, these options don't decay in a linear fashion. Their decay is more exponential. Okay, so people who like to sell options generally target options that are anywhere from about 30 to 40 days out. And that's because, as you can see right here at about the 30 to 40 day mark, this line starts to get a little steeper. Further out, longer dated options, yes, they do decay, but they don't decay quite as much as the near dated options. Now, in the money options, as well as out of the money options, they don't have as much extrinsic value. Okay, like very deep in the money options, whether they're calls or puts, are going to be comprised of mostly intrinsic value and very little time premium. So those options, while they do decay somewhat in a more linear fashion. But as you can see, it's these at the money options that are really affected by changes in time, and the 30 to 40 day mark is really where things start getting interesting and these options start to decay more rapidly. All right, so let's look at dividends and how options are priced for dividends. So typically a dividend is, as many of you know, is a cash payment. It's paid to shareholders on a quarterly basis based on a company's profit. So if a company throws off a lot of cash, they are not going to make a bunch of capital expenditures. They'll typically, if they don't know what to do with that cash, they'll return it to shareholders in the form of a dividend. Now, only stockholders are entitled to a dividend. Call holders are not entitled to a dividend unless, of course, they exercise their contracts and take delivery of shares in advance of the ex-dividend date. We'll get into that in a bit. So when a stock goes ex-dividend and it pays a dividend, that stock price is generally reduced by the amount of the dividend. Okay, so let's just say we have a stock, it's trading 50, and let's just say it's going to go ex-dividend tomorrow for 50 cents. So tomorrow, in theory, that stock should open up at 49.5. Okay, so the stock's going to open at 50 cents lower. That 50 cents would go to the shareholders. So the shareholders don't really lose any money. Their stock's 50 cents less, but they get paid 50 cents in the form of a dividend. Now, the options are priced for this. Okay, options, that stocks that have that pay dividends that are ordinary. In other words, they pay a consistent dividend stream. Options can price for this. Okay, so for calls, a dividend will typically reduce the value of a call option and increase the value of a put option, just because when it goes ex-dividend, it's going to drop by the amount of the dividend in theory. So that's going to lower call values and raise put values. So this all gets priced into options. Dividends and interest rates are factors that do get priced into options if the dividend stream is known. Now, here are some important dates when thinking about dividends. So there's the declaration date. This is the date on which the board of directors announces a dividend. Okay, they'll announce the dividend, the size of the dividend, the record date, and the payment date. Now, the ex-dividend date is key. So this is the date when shareholders are disqualified from earning a dividend. So if I own a stock today and it goes ex-dividend tomorrow for 50 cents, I will receive that dividend. If I buy those shares tomorrow on the ex-dividend date, okay, I'm going to own the stock, but I'm not going to get the dividend for that quarter. I'll get the dividend for the next quarter. But know that you have to be an owner on record before the ex-dividend date. Okay, so investors who buy shares on or after the ex date will not receive that dividend until the following quarter. So on that date, the shares trade ex-dividend or excluding the dividend, because if it's a $50 stock and it pays a 50-cent dividend, tomorrow it should open up at 49.5. It's going to be trading without the dividend at 50 cents lower. Now, the record date is the date when the company takes a snapshot of all of its books and basically determines who's a shareholder and thus who will receive the dividend. So in most cases, the record date is 2 days after the ex-dividend date. Now, the payable date is the date which the dividend should hit your account. And this is the date that you can expect to see it hit your account. And that is the payable date. So, and this is all very important because I'm going to show you in the next slide. why this is important for people trading options. So, and this is really important for people who like to do covered calls. Now, covered calls are a strategy. It's probably the most popular of all the option strategies. And a covered call is when you basically buy 100 shares or more of a particular stock, and then you sell one or more calls against it as for income. And people will use the covered call as an income generating strategy on stocks that they're kind of neutral to moderately bullish on. It's kind of like creating a synthetic dividend stream. But you're going to want to know this formula if you're somebody who likes to trade covered calls on stocks that pay large dividends. So if using our example before, let's just say stock's trading 50, it's going ex-dividend tomorrow for 50 cents. And let's just say we're short the 45 level calls, okay? Those calls are $5 in the money. And maybe they're trading in the marketplace for $5.10. So we know that $5 of that $5.10 is intrinsic value and 10 cents is time premium or extrinsic value. Because the dividend of 50 cents is larger than the amount of extrinsic value in the option than 10 cents, this option is a strong candidate to be exercised early for the dividend. As I alluded to earlier, remember that anybody who exercises a contract early, there has to be an economic incentive to do so. And the reason why somebody might exercise a call early primarily is for a dividend. In other words, they would be foregoing the 10 cents of time premium left in their option to capture a 50-cent dividend. And we get calls from investors all the time saying, you know, I had this covered call on, and I woke up the next day and I had a bunch of money in my account, but I didn't receive the dividend. Like, what happened? Well, what happened was the person, you know, you were long stock and short the call. The person who was long the call decided to exercise for the dividend. In other words, they were willing to forego 10 cents in the option to capture the 50-cent dividend. So knowing this, if you're somebody who likes to do covered calls, or, you know, if you trade, you know, debit spreads or whatever, you're going to want to know this formula. So once again, if the time premium in the option is less than the amount of the dividend, that option is a strong candidate to be exercised before the ex-dividend date. Now, it typically would happen the day before the ex-dividend date, but it could also happen, you know, 2 days, 3 days, whatever the option holder wants. So if you're in a situation like this, you might want to take mitigating steps to prevent that. So if you want the dividend, you don't want to be signed on the call, you're going to want to buy back that short call either for the X date, either buy it back and stay long the stock, or buy it back and roll it. This is called rolling, where you buy back the short call to close and you sell a higher strike call against it. You'll take in a little more premium, but it'll mitigate against being assigned on a stock early. So once again, you can always shoot us an email and ask us more about this. And we've done extensive webinars just on covered calls. So you know, it's just something that I can't emphasize enough. But once again, keep that formula in mind, that if the dividend's larger than the extrinsic value left in the option, and you have a option that's about to go ex-dividend, you just know that option's a strong candidate to be exercised early. Okay, so that is the end of the presentation. I know that was a lot of information, but if you ever have any questions, once again, you can always shoot us an email at options@theocc.com. You can check out our website, optionseducation.org, for additional webinars, for additional podcasts. We have an education course, all free of charge, completely free of charge. We also have our own YouTube channel. So if you go to YouTube and you search for the Options Industry Council, we have a YouTube channel where we have archived many of our past webinar presentations. So if there's a subject that you'd like to learn more about, whether it's implied volatility, whether it's covered calls, butterflies, corporate actions, anything that you can think of, you can always shoot us an email at that website. So with that, that is the end of the presentation. I know we have a little time left over, so I'm going to take a look at the Q&A box. If you guys have any questions, you can always just use the Q&A box, and let's see if we can handle some Q&A here. So let's see, the first question: I use eOption to trade. How do I set up a stop out with one cancels all? Okay, I'm sorry. I'm not familiar with the eOption platform, so I would reach out to Gina or somebody at eOption regarding the use of their platform. I'm sure they can walk you through that.
Ken, if I can just answer that question.
Absolutely.
Sure. Thank you for your question on our trading platform. So we have an excellent trade desk that would be happy to answer all your questions and walk through how to set that up. And just for everyone on that call, you can just, you could either shoot an email to support@eoption.com or feel free to give us a call. We're at 888-793-5333. And we have a very experienced trade desk, and they'd be happy to walk that through to set that up for you. So I just wanted to interject that. Thank you.
Sure. Let's see. How about there's another question here. If I'm short an options contract and it closes out of the money, can I still be assigned on it? Okay, this is a really good question. So let's just say it's at expiration, you're short the 50 level calls and stock closes at 49.5. Okay, so it closes 50 cents out of the money. And you're at expiration, you think, well, this option looks like it's going to expire worthless. I'm not going to buy it back. I'm just going to, let it expire worthless. And, but what if some news came out after the close? Okay. And news does come out after the close on expiration. What if all of a sudden some bullish news came out? Maybe the stock is going to partner with another company, or there's a merger in the works or something. And all of a sudden that stock goes from trading 49.5 to trading 55. Well, just know that even though your option closed out of the money, it can still be assigned. So know that just because it closed, the stock closed at 49.50 and you're short the 50 level calls, if somebody chooses to exercise that contract and they get their exercise notice into their broker by their broker's cutoff period, that option can still be assigned. So the only way to truly mitigate against an unwanted assignment is, if you're somebody who likes to sell options, is to buy back your short options on or before expiration. Once you buy back to close your options, there's no possible way you can be assigned on those options. But this does happen, and it happens a lot when news comes out and people don't cover their short options. So for exercise cutoff thresholds, OCC requires that our member firms get their exercise notices into us from the exchanges 90 minutes after the New York close. Now, your broker might have a different cutoff period. So if you are, you want to check with your broker, I've heard of some notable brokers have exercise cutoff thresholds as little as 10 or 15 minutes after the close. So it's going to fluctuate depending on your broker. So you want to check with your broker and decide whether you would like to, exercise, or I'm sorry, if you want to, if you are long contracts that you want to exercise, even though they appeared to close out of the money, you could choose to exercise. I mean, you'd have to file what's known as a contra exercise notice, but you still could do it. Now, just as likely, you could also not exercise an in the money contract. What if you were long a 45 level call, the stock closed at 50, and then all of a sudden, if you did nothing, you would just automatically exercise it. If you didn't cover it, it would be automatically exercised because it would be more than a penny in the money. And in this case, you would pay your strike price times 100, $4,500 per contract, and take delivery of 100 shares. But what if some bad news came out in the aftermarket and stock was trading 35? You could, in fact, elect to not exercise an in the money contract. But once again, you would have to do so by your broker's cutoff threshold, filing a contra. It's called a contrary exercise notice, also known as a contra exercise notice, but you would have to do so manually through your broker. So once again, if you wanted to not exercise an in the money contract for whatever reason, or exercise an out of the money contract, that's something you could do, but you would have to do so through your broker by your broker's cutoff period. So let's see. And, once again, if you ever have a question that comes up and you're like, man, I wish I asked that question during the presentation, once again, you can always shoot us an email at options at theocc.com with any of your options related questions. It can be any question. It doesn't have to necessarily be about this presentation. So, with that, I know we are running up against our time limit, so I'm going to hand it back to Gina for some closing remarks. But once again, I want to thank everyone for joining us here today, and I look forward to presenting again the next quarter. So, thank you, everybody.
Great. Well, thank you so much, Ken. That was very interesting and informative. And thank you to all our attendees for taking the time out of your busy day to join us. And just a few reminders before we go, and I want to tell you about a special free stock promotion we're having. So first, a recording of the webinar will be available on our YouTube channel tomorrow. So make sure you subscribe so you don't miss any of our videos from trading experts and professional traders. That's at youtube.com/eOption. And I also put the direct link in the chat box so you can click on to subscribe. But we do offer all kinds of great videos as well as all different kinds of playlists, no matter what level of option trading you're at. So if you're a beginner and you want to learn the basics, more like this video that Ken did today, or you want to learn about straddles and different various kinds of spreads and strategies, we also have wonderful playlists on there as well. So feel free to check that out. And if you go to eOption.com, it's a plethora of resources. So we also hope you'll check that out. We have this wonderful section on clickable option strategy links. So if you want to learn more about a strategy, you can click on it and it'll show you a video and explain it, the motivation for using it, the profit and loss. So we hope that you'll go to our website and play around with it and check it out, because it really does have some tremendous free resources for you on there. And then if you go on our website, there's a rewards tab. If you go there, we are doing a special promotion for Easter. And so for every referral that you make, who opens an account, both you and the person that you refer will each get free stock. And we're actually giving Hostess stock, and the ticker is TWNK for Twinkie. So that's about a $50 value. So if you are interested in that, feel free to check out our referral program. That's just a fun one we do for Easter. And also, just want to mention some of the free tools that we offer for you. We do offer something called Options Play that for beginner option traders, it really does demystify option trading and helps you to learn more and set up the perfect option trade. So we hope you'll check that out as well. It's on our website. That'll give you more detail. And last, our next webinar will be next month on Wednesday, April 19th. We're having our professional trader, Teddy Keckstad, go live and show you real time how to use technical analysis and options. So we hope you'll put that in your calendar, and you can register today if you'd like. So thank you again for your time. We greatly appreciate it. And we hope you have a wonderful afternoon. And eOption is always here if you have questions about your trading and options trading or stock trading. So thank you again and have a nice afternoon. Bye now.